Most people think keeping money in the bank is safe, but in 2006, idle cash could quietly destroy your wealth. This isn't fear-mongering, it's a mathematical certainty. Debt levels are at historic highs, central banks are printing money faster than ever, and inflation is silently eroding purchasing power. The financial system is a machine, and if you don't understand its mechanics, you are unknowingly feeding it while losing wealth. Today we'll break down exactly what to do with your money before the next phase of the cycle hits, and why gold, real assets, and disciplined strategy are the only way to survive. The mechanics are clear. In the late stage of a debt cycle, governments and central banks face a choice: either default or devalue the currency. History shows that default is rarely chosen. Instead, they print, inflating away debt obligations. That means cash, once considered safe, loses value silently but consistently. Middle-class Americans, trusting in savings accounts or traditional fixed-income investments, are most vulnerable. While markets may rise or fall temporarily, your purchasing power erodes quietly beneath the surface. Understanding cycles is critical. The big debt cycle repeats over centuries. Debt rises, interest payments increase, confidence weakens, and currencies are devalued. This is not speculation, it is structural. Those who anticipate these cycles act in advance by reallocating capital into assets that preserve value. Those who ignore it are unwitting participants in a wealth transfer. The first step in survival is recognizing that cash is not neutral, it is policy dependent. Every dollar you hold in a bank account is a liability of the government, subject to printing, devaluation, and systemic risk. If you plan to rely solely on cash in 2026, you are positioning yourself on the losing side of a predictable pattern. Gold emerges as the primary protection. Unlike paper assets, it is not someone else's liability. Gold maintains purchasing power across centuries, empires, and crises. It acts as a hedge against inflation, currency devaluation, and systemic uncertainty. Allocating a portion of wealth to gold is not speculation, it is mathematical and structural. Real assets are equally important. Commodities, income-generating real estate, and productive businesses create intrinsic value independent of currency movements. These assets anchor your wealth in tangible productivity, protecting against systemic shocks that erase cash balances and destabilize financial promises. Discipline is essential. Most investors act emotionally, waiting until panic strikes. The elite act early, positioning their wealth according to principles derived from historical patterns, not headlines or speculation. Timing matters. By the time the mainstream notices danger, exit doors shrink and opportunities vanish. To survive 2026, middle-class Americans must shift their thinking. Cash is a tool, not a safe haven. Diversify into gold, real assets, and productive investments. Anticipate systemic forces rather than react to them. The machine is predictable, but only if you understand it and act before it moves against you. Understanding the problem is only the first step. The critical question is, what do you do with your money now to survive 26's systemic pressures? Most people will wait for headlines, panic during volatility, and lose wealth while the elite quietly position themselves. The principles are clear: diversify, think structurally, and act early. The first principle is diversification across uncorrelated assets. Most investors believe they are diversified by holding multiple stocks or bonds, but in late-stage cycles, correlations increase. Assets that seem separate often move together under stress, leaving your portfolio exposed. True diversification involves holding assets that behave differently under systemic shocks. Gold, commodities, productive real estate, and cash alternatives that are inflation protected are all examples. By spreading wealth across these streams, you reduce risk by 70–80% while maintaining growth potential. Gold must be a cornerstone. Its value does not depend on anyone else's promise. Historically, during debt crises or currency devaluation, gold preserves purchasing power. The math is undeniable. When fiat currency is debased, gold rises proportionally, protecting wealth. Allocating a portion of capital to gold today is not speculative, it is structural protection. Commodities are another critical asset. Scarce resources like oil, metals, and agricultural products maintain real value when currencies fall. Unlike paper instruments, their worth is tied to tangible demand. They serve as hedges against inflation and systemic risk, providing stability in a turbulent environment. Real estate and productive businesses anchor wealth in actual cash flow and intrinsic value. Owning a property that generates rental income or a business producing goods and services protects wealth from currency depreciation. These assets are independent of government policy and are not reliant on the stability of financial promises. Timing and discipline remain essential. Many investors will react emotionally to market swings or news, buying high and selling low. The elite operate on principle. They allocate early, maintain discipline, and adjust portfolios according to structural changes, not sentiment. The window to act is finite. By 2026, opportunities to protect wealth in real assets will shrink as prices adjust and systemic pressures mount. Finally, principles-based investing is key. Every allocation decision should consider 1. Alignment with systemic forces, not temporary trends. 2. Protection against permanent loss, not short-term volatility. 3. Exposure to uncorrelated assets that respond differently to economic shocks. By following these guidelines, wealth is not just preserved, it is insulated and positioned to grow during turbulent times. The silent erosion of cash and over-reliance on unstable financial instruments will make the unprepared the victims of a predictable pattern. In short, survival in 2026 is about anticipation, structure, and disciplined allocation. Cash alone will fail. Real assets, gold, and commodities are the anchors, and those who understand this machine will have the advantage when the system begins its next move. By now you understand the systemic risks of 2026, why cash is eroding, and how gold, commodities, and real assets protect wealth. But knowledge alone is not enough. The difference between survival and loss in this cycle comes down to discipline, timing, and principle-based action. The first principle is discipline over speculation. Most investors react emotionally to headlines or short-term market movements. They buy what is rising, sell what is falling, and fail to see the underlying structural forces. The elite operate differently. They allocate capital based on long-term principles, not momentary fear or excitement. This is the mindset that preserves wealth while others panic. Second, timing matters, but it is about cycles, not daily prices. Understanding when the system is entering a late-stage debt cycle is far more important than guessing market tops or bottoms. The big debt cycle moves slowly but relentlessly. By acting early, reallocating cash into gold, productive assets, and commodities, you position yourself ahead of the crowd. By the time most people notice danger, exit doors will be small, crowded, and expensive. Third, principles-based allocation is critical. Every dollar you deploy should be evaluated through the lens of systemic risk. How will this asset preserve purchasing power during currency devaluation? Will it generate real value independent of government promises? Does it diversify against systemic shocks? Following this logic, the core 2006 survival strategy is clear. 1. Reduce idle cash exposure, only keep enough for near-term obligations. 2. Increase allocation to gold, the ultimate non-liability hedge against devaluation. Invest in real assets, productive real estate, businesses, and commodities that maintain intrinsic value. 4. Maintain diversification, spread capital across multiple uncorrelated streams to reduce risk. Most importantly, act now. Preparation is invisible until it becomes essential. Those who wait until panic hits will find opportunities gone and wealth quietly eroded. This is not fear, it is historical inevitability. Every major debt cycle has rewarded those who understood the system and punished those who did not. Finally, commit to a single actionable principle today. Write down one step to protect your wealth. a percentage of cash to move into gold, a new allocation to real assets, or reducing exposure to over-leveraged financial instruments. Hold yourself accountable. The machine does not care about excuses. It only respects preparation, discipline, and math. In conclusion, 2006 is not a distant threat. It is the next chapter of predictable systemic forces. Cash alone will fail. Gold, commodities, and real assets will anchor your wealth. Discipline, timing, and principle-based action are the tools that distinguish the prepared from the unprepared. Ask yourself, will you be ready when the system moves, or will you watch silently as wealth is quietly transferred away from those who hesitate? The choice is yours and the time to act is now.